Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, January 24th, 2022. All right, so the index reversed right about where they should have. Remember in QQQ, had swing target for the daily chart, first swing target right here. There are additional charts, those are on the weekly chart. And the target zone ran from 342 down to 342.41 down to about 355.54, and that's almost exactly what we hit. A hair below it, little momentum fueled overshoot, also almost a perfect tag of the. Well, we parked. That's what happened. So, well, not a perfect tag. We sliced through it. This is a weekly chart. Really, all that matters is how we close the week. But that's the initial tag or reaction off there. We had again a tremendous amount of downside momentum or velocity going into that move. That's what I call momentum fueled overshoot. This is a 60-minute chart. Let me turn off the after-hour trades and show you what it looks like. So there was a slide. You know, when the dam pretty much broke once we failed those breakouts on QQQ and SPY. I'm talking about on the daily chart, those trading ranges back there. And so once those were given up, QQQ had a little last minute bounce and then gave it up, and you can see big slide. So that's what happened. If you closed your lightened up positions on Friday, you're right back to where we started. Let's talk about today's reversals. Pretty impressive stuff, but you know, again, that's why I try to get those videos out and those updates. You know, better to be early. Somebody mentioned this morning, you know, on the site, hey, should I close out? It was early this morning. Someone else said they did close out their shorts, you know, 10:30 or so. Better to be early than late when it comes to shorting the market. See, when you short, I love it because the profits are they come much faster and much more powerful than trading bull trends. Usually stocks tend to fall a lot faster than they rise. So again, as I covered here, you wiped out going all the way back to by the end of or the lows today. All these gains going back for almost 8 months here, all the way back until June, the beginning of June, were wiped out in just a matter of a couple weeks here. However, the flip side to it is you got to be very fast. You cannot stay too late to the party. Now, nothing's changed in my longer term view. If you did nothing today, you're short, you got in early, I still think it'll play out. No guarantees, but let's talk about the levels to watch. So there's the reversal. Here's those 5-minute charts I covered earlier in the video today. Bullish falling wedge on the 5-minute chart with divergences there, RSI divergences, breakout, and there's the gap. This yellow dashed line shows you Friday's close, and so there it is. We backfilled the gap. These white little bars are after hour trades. Don't you get these quirky? These are, I call them erroneous prints. These quirky candles. These are the trades right here. So we, for all intents and purposes, it's almost a perfect backfill, just slightly above it. And again, you're going to have just as much momentum. Remember, from the low to high, in just a few hours today, the Nasdaq 100 gained almost 6%. There it is right there in the pop-up box to the left, 5.89% from the low to high, right around the close. Yep, that was our closing candle. 5.9% off the bottom. And so that's going to carry you through there. And now here's where I'm at. Here's where I think, you know, probably fade this a little bit in the after hours tonight. My guess, again, fade that back. If you're going to trade the Qs or NQ, you want a line right here. You'll probably get this. Then I think just probably chop around, grind around, possibly aimlessly. What I mean by that, if grind around is one thing. As an active trader, I like grinding around. If you can identify levels to go long and short, cover, reverse. But an aimless grind is just back forth with really no rhyme or reason, and that is, from my experience, what tends to happen as you approach the final, you know, a couple days before the FOMC meeting. So remember, the meeting starts tomorrow, ends Wednesday at 2 p.m. And so I think it's a great time for active traders, that's what I'm speaking to now, that we're able to reverse and play that long bounce to maybe just sit back. Max bounce targets remain not, well, yeah, look, I don't think we're going to get there, but I'd be okay with a move up to back test the bottom of these ranges in SPY and QQQ. But it'd be really nice to see the Qs come up and check the 200 days, because I said that's just those levels often act as support and resistance. They're great support, those 200s, when you're in an uptrend, and when you break them, boom, back test fail, boom, back test failed. Support, once broken, acts as resistance, and once you regained it, it's support again, and then boom, 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 pullbacks worked. So again, no guarantees, but that's how you do it strategically. So the way I see it is, the backfill the gap was a very likely in a short-term target, as nice as the bounce was, but that would be more of a range from there, from where we hit today, to there. So, my preference and what I did in the longer term accounts, you take some, adds back some short exposure if you happen to lighten up before the weekend, or if you game the bounce and reverse long. This is a scaling level from where we're at right now as I'm doing the video, all the way up to, but really not much. You can hold on and allow a little more room on your stops, but it really wouldn't add much above those 200s. If you pop the 200s on the QQQ, and remember, they're different, they're going to come in differently on QQQ and SPY. If you happen to pop it, but then you see a failure back down below it, maybe you could add there, but I wouldn't be adding much back there. I'd scale in from here at about 351.68. Remember, that was a support level there. I had that blue line, that target, up to, but not much above the 200 simples, a little bit above the exponential. Comes in right now at about 365.50. And that's how QQQ looks. On SPY, same thing. If I can queue up SPY here. SPY on the daily at that 424.45 target with a little bit of an overshoot. From low to high, the reversal in SPY was measured here on this 5-minute chart. That was good for about a 4.5% bounce. Remember the Qs, that's why I like to trade them. It's simple. You're going to either get the call right or wrong on the markets. And if you get the call right, you're going to make more money more often than not. Not every time. Depends what the financials are doing, some other things. But usually you're going to make a higher return if you go long or short the Qs versus SPY, because it's higher beta. It's higher beta against the S&P 500. Goes up more when things are rallying and doing good, and the markets are doing good, and it goes down more when they're doing poorly. All right, so that's it, and you can see SPY, just a nice backfill. These white candles, again, this is the after hour session. We're just kind of flattening out here. And again, you want to, this is just a micro call. What I think will probably happen tonight, we'll get a pullback there, maybe even in the after hour session, maybe tomorrow morning, and then probably grind around. That'd be my guess. But again, if you played the bounce and you got any or even part of that 5% reversal, you're ahead of the game now. You can go flat. I think that's probably a good plan to keep it light. I would actually, at this point, again, I just said it earlier, a minute ago, layer back in. If you lightened up, took profits, whether you gamed it, I think it's time now, because the sell signals that we have on the weekly have only been firmed up to start scaling back in, doing the same thing that I was just talking about on QQQ. You have on SPY, we had, let's see, what's going on here? Oh, those were old targets there. This is a 60-minute chart. That's right, I didn't lay out the targets numerically like I did on QQQ this time around, last time I had it. But you can see there's the gap right there filled, backfilled. And there's that top of that trading range. So I'm going to turn off all the lines here just real quick, and again, highlight that there's the trading range, which was also a breakout to new all-time highs, took out that previous high from right back there. And so that would be really, again, about a max bounce target there. And so there's your scale in zone if you want to scale back in short. Anywhere from here, that could prove to be the end point of the rally, up to there. Anything much more than that, I'd be more concerned about stopping out versus adding to any short positions at that point. It's a relatively small window. It's really not talking that much, about another 3% maybe, not even, less than 3%. I'm sorry, at least on SPY. There's a SPY weekly. I wanted to show you IWM in the video earlier today. I gave you a mid target. Up until now, up until earlier today, I was Hadn't given you any intermediate targets. I had just one big wide, target all the way down here, 171, which would have been almost a 20% drop. And I kept saying we're not going to go straight there. There'll be zigzags along the way. So this is where the most likely zig was. It's the only support level, literally the only support level on the weekly chart or daily that I had in between. That's that line I gave you during the video, and boom, hit it to the button. And that was when SPY and QQQ are also hitting support. And the small caps were good for about almost a 6%, 5.8% rally off that level. I have, again, nothing has changed in my intermediate to longer term outlook. I think it's just an expected oversold counter trend bounce. How much more? Up, same thing. You've got a wall of resistance. That's it. Does not guarantee that we can't go to new highs from here. It doesn't guarantee a new bear market has started. But I can tell you this, with certainty, that's big resistance. And anywhere through there, even if you pop it slightly, you get little micro levels within there. You got all the key moving averages, the 50, 200, 50-day and 200-day averages are up in there. So you're looking at most likely at most anywhere from about 4 to 8% upside before you hit some major resistance. That's the bottom of this coming in, bottom of that zone, or about 3.5% above. Yeah, somewhere around there, about 3.5% above. And then the 200-day moving averages and the 50. You can see the 50 is poised to make a bearish crossover below the 200. That's this yellow line. It's the 50. Red's the 200-day, both exponential. That would give you a death cross. Last time we had a death cross, let's just turn everything off and just for fun, kicks and giggles, right here. That was the last time we had a death cross. That's when the 50 crosses down below the 200, and that's a golden cross when it crosses back above it. If you shorted IWM, we were already short the markets before that even took off. There was a little bear flag in there. That was just confirmation of a trend change, guys, and that was caught the bulk of the biggest bear market. I mean, that bear market from high to low was roughly 43% in the small caps. So whatever, I'm just, again, point is there's just mounting evidence that there's probably more downside to come. And as impressive as today's reversal was off the lows, it was technically induced. Markets hitting support, extreme oversold conditions. I covered that during the other video. The RSI at that point was the lowest point that we had since back when COVID first hit, right there, and so forth and so on. And let's keep this one limited to the equity markets, and then I'll do updates on everything else. I did cover crude, nat gas, lumber, what else? Most everything else. A lot of the other trade ideas in today's video. The VIX I updated earlier today. We hit T1, and then the markets went on to actually that coincided with the lows in the markets. We effectively hit T2. Remember, back in the day, I used to do what I call adjusted price targets. Took a little more time. I would do, and I still will occasionally. If I say T5 equals, T4 equals, then that means I've done an adjustment. And what I do, I turn off the level on the trend lines or the support and resistance lines. But when it's just like this, these are the actual support and resistance levels. And I always say on long trade ideas, you want to sell a little shy of the actual resistance. That's what I used to do with the adjustment, just based on experience and eyeballing that. I'd set the targets a little lower. So that is effectively a hit. Because we went to as high as 27.84 today. The line was at 28.25, and you can see visually it's right there. And so again, that's I would say set your sell limit orders just below the actual resistance level or levels that you're targeting on longs. Likewise, when you're shorting, you want to set a little bit above. However, usually in waterfall type situations, you tend to overshoot. It's the more controlled corrections that where there's not panic selling. That if you have, let's say, a support right here, and you're just meandering down to it, that's often where the buyers will step in early and sometimes reverse. And my logic is why risk a reversal and missing your target to squeeze out a last, 1/10 or 2/10 of a percent on a trade that's already, 10-15% profitable. It's just not worth it. That's why. Or the other thing I really like to do, especially during times of market volatility and big movements, is instead of setting a limit order, set a trailing stop and tighten it up when you get down there. So if you're targeting, let's say 320 on QQQ, you think that's the support level it's going to bounce at. When it gets to about 322 or so, we're close enough. Again, if you have the ability to be in front of the computer, set a very tight trailing stop. 30 cents. You could do a fraction of a percent, and what that'll do, in case there are times where you just have little to no reaction, you blast on through a support level, and it keeps you in the trade. And the worst case scenario, if the trade reverses, you're going to have locked in almost all those profits. Or even if you overshoot, trailing that stop is going to lock you in down below. The trailing stop will follow your position down tick by tick and reset the stop automatically for you. And before I wrap it up, oh yeah, somebody asked. I'm sorry about that. I keep not covering the future. Somebody asked for futures charts today. I did post those under the comments section. Here's the NQs. This is a short-term 5-minute chart with some candles. It was a minor trend line that it really didn't get valid. We had 3 reactions, but never a fourth. We went through it, so I'm not crazy about it now, but I'm going to leave it up because maybe it was overshot. I just showed you a minute ago on the Qs. I'm looking for, in the after-hour session, SPY, probably a little pullback. So I could see something like this come in there. Actually come somewhere around there. That'd be a pullback target. But here's your resistance levels. I have it at 14,520. We'll call that 14,520.50 or so. 14,583 and then 14,680 right there. Those are all relatively minor but decent resistance levels that should, quote unquote, should cap the rally. But again, then you also look at the daily charts on QQQ and all that. Let me look at a 60-minute chart for you real quick. 60-minute chart, we're back to that. This was way back here before we even, market even broke down. We had sell signal 1, 2, multiple short entries there, and that's when I added shortly after we got going, the if the dam breaks and things get ugly. Well, the dam broke. My analogy is really that trading range, that multi-month trading range. That's where the dam broke, right? And we went right on through there. And I think if you look at even a longer-term chart, let's see, what's it? Daily chart. I had another level here at about 14,046.50. But here's the bigger picture on the NASDAQ 100 when we're looking at the daily. If you're looking at the futures, we're well below trend. Remember, we had a big rising wedge, divergence, and all that. And we went this low today, and we closed right back on that old target. And so you have resistance levels overhead here at 14,831, 15,159. So there's still a lot of resistance overhead, as well as the moving averages. Also use QQQ and SPY. A lot of traders use those. And this is the big level right here. This is the one that started it all. Well, it was actually beautiful because it was an intersecting uptrend line plus that consolidation range right there, the breakout above that previous all-time high. And so that's when things got ugly. So that's a nice breakdown. Again, charts based on my read on the charts, this is only the first wave of a bigger correction or bear market with more to come. If that changes, it'll start. I'll let you know. It's going to have to do a lot of work here. Really, look, bottom line, it's got to take back that trend line and the bottom of that trading range there, that 615, we'll call it 15,700. Unless it remains below there, I'm not going to change my longer term outlook unless I see something else that convinces me otherwise. Anything is possible, but as of now, I just want to be clear, we're in short the rips, cover the dips mode. Instead of back in a bull market, buy the dips, sell the rips. And in a bear trend, you sell the rips, meaning rips back into resistance, and you cover the dips down to support. Or you just sit tight, again, if you don't want to worry about all this. And then ES, S&P 500, there's some micro levels. We're at 4406 now. That's resistance. I can see some resistance here. 4427.50 is even better resistance, a little overhead. But again, I think we'll probably have a little jog back tonight and then just grind around for the next day or two. Looking at the daily chart, I don't know if I had, no, I didn't have that marked up. I might have had the 60-minute or 6-month marked up. Let's see, 60-minute chart. Nah, it's messy. There's our breakdown happened long ago. The time to be short was back here, but the time to be getting back into shorts is coming up. We're going to kick back and hit those levels again I showed you on the SPY. Um, let's do that real quick. Moving averages on the SPY. This is the daily chart here. There's where a candle took us back to. There's the 200-day. We're right on the 200 exponential, right between that and the 200-day simple moving average, with that big 450 level right there. Again, the bottom of the range, the breakout to all-time highs, right there, which has failed. So this is your scale and zone. It's very simple. It's a relatively tight zone. And this is your stop out level, where your stops are dependent on where you think this is going. But really, at this point in time, there's no business to get up here anywhere close to the new highs. So you can keep your stops relatively tight, in my opinion. And if you want to play it safe, if the Fed tries to pull some shenanigans to pump the market on Wednesday, you could always just hold off and use a daily closing basis above a resistance level for your stop instead of intraday. Because when volatility is high, the one thing is you're going to get those intraday breaks of support and resistance, those whipsaws. And most important thing is how you close the week or the day on the daily candle, and how you close the week on the weekly charts, where the weekly candles close. And as of now, the weekly charts still look all out bearish, in my opinion. We're just fresh, coming off, relatively fresh off a breakdown on the weekly charts, which indicate more downside. And one last tip before I wrap this video up, I like to share it with everybody from time to time. One of, I think, the most effective tools available to traders nowadays, whether you're an active trader, but even more so if you're a part-time trader, you work a full-time job, or you're retired but you just don't want to sit in front of a computer 8 to 10 hours a day like I do 5 days a week. Then the thing for you want to get out and golf or jog or do whatever you do. OCO orders. OCO means one cancels the other. And some brokers refer to them as, or call them, OCA orders. Let me just color this up. And so an OCO or OCA order, one cancels the other, or one cancels another if you have OCA. It's simply you put let's just say, for example, let's just say you went long here when we're at the top of that range, and then you added to IWM there. And so you have your average cost basis somewhere in the middle there, and you want to stop that. You're going to swing for this target down here, that 171 level. But you want to stop right here. That's going to assure you at least a break even or a small profit, and that's going to be at we'll just say 230, and we'll call that 170, right? So it's simple. You set an OCO order. Make sure you do pick good to cancel, not day, because if you do a day order, the order is going to expire at the end of the day at 4 p.m. So you do an OCO or OCA, good to cancel, and it ties in. Your broker can help you with this, or you might have to, if you want to do it yourself, look for their advanced order types. And it's going to be two orders. It's going to be a stop loss. So you set a stop loss at, again, in that case, 230. And you set a buy to cover limit order at 170 or 171, whatever you want to say. And that way, if we go up here, and this is it, that's all the correction is, just like the rest, we're going to go to new highs, then you're going to be stopped out, and no matter where you are, that order is going to stay on there, and it will automatically cancel that other order for you right away. And likewise, if we turn around and we go down and hit 171, your order will be filled, and then it's going to cancel the stop order. So that's, again, a very helpful tool. It not only is good for those that, again, don't have the time to be in front of the computer all the time, but for also Those that may have quite a few positions in various accounts, I mean personally between family accounts, personal accounts, IRAs, 529s, Coverdale ESA accounts to the kids, IRAs here or there, SEPs, things like that. I mean it's dozens. And that's the only way to effectively manage all those positions, especially in a fast-moving market. You can't log on into each account. I have accounts at many different brokers. And then the other thing is discipline. That's the thing a lot of people lack, especially in these kind of markets where things start moving fast. You second guess yourself, and the market's down so much today. If you went long a little too early, you start second guessing that. If you were short and you see these huge gains in the last few days on your short portfolio, you're probably tempted to take profits because it just hasn't happened in a long time where you've seen such quick gains so fast shorting. And the OCOs give you that discipline that a lot of traders lack. Set them and forget them. The only time in trading, number one, you should always have a trading plan on every trade. Before you go into a trade, what are you going to buy? Why are you buying it? Where are you going to sell it if correct? And where are you going to stop out if wrong? That's part of a trading plan, your stops and your price targets. And the only time you should modify a plan, it depends. Sometimes you might, go by gut feel if something big happens, but usually something needs to convince you, or at least me, in the chart. Something needs to have changed, whether it's a character of something that I'm watching or something that I missed earlier that I might have found in the charts. Otherwise, sit tight, have faith in the charts, and stick with your plan, and that's what an OCO will do, is just let you be hands-free. It's like putting the trade on autopilot and trusting that it'll keep you on the road. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart, and have a great day.